So what I wanted to talk about today is like what strategies are wealthy people using to pay less tax, and what more specifically are they not using? Because I've noticed this quite a bit. There's a lot out there on strategies that people will say that the wealthy are using that I like. It's just different in what I see day to day. There are a lot of strategies that are more gimmicky that the wealth people aren't actually using. And so I want to talk through some of the strategies specifically, and then some of the kind of principles behind how I have observed wealthy people thinking about taxes and thinking about money in general, as opposed to what some of the common misconceptions are. So let's go ahead and jump in again, sort of to why I'll talk about this first one later, but the other one is like, I think that a lot of accountants have fallen into that, like a hammer sees everything as a nail. So we see every tax strategy as something that could and should be used, and see taxes as always like they should be zero. And that's not actually the best way to think about things in my experience. So again, we'll talk about that. And then also, just success and wealth come down to a lot more than bank balances. And so there's more things to consider, even when we're thinking about like being wealthy and how to achieve that wealth and financial freedom, than just bank balances. There's quality of life things to consider. There's reputational things to consider. There's risk things to consider. So we'll get into all of that. First, I just want to talk about like defining wealth and what it really is. So wealth, the way that I consider it is that it's freedom. It's freedom with time and money and having control over what's actually happening in life. And that, of course, comes down to, as I was just saying, a lot more than bank balances. So how do we actually achieve those things? Well, the formula that I have seen work, and that seems to be a time-tested, formula, is one, you've got to have something that generates income. Two, you have to spend less than you earn. So saving 10% on an ongoing basis, 10% off the top goes to savings for the purpose of investing. That's separate from like an emergency savings. This is for investing. And then three, invest wisely into assets that have both cash flow and appreciate over time. So that in the stock market, that looks like dividends for cash flow, and then obviously the value of the shares. Real estate should cash flow in and of itself and should appreciate over time. Same thing with investments into businesses themselves. And this is why I think entrepreneurship is perhaps the most powerful wealth builder in available to us in our country, because it allows entrepreneurs to, one, have a really good engine for generating income, and two, to within that same engine build residual value and have an asset that is part of the overall wealth formula, all in one. And there are three components to good investments. The first one is that it's something that you have expertise in, something that you have, frankly, an unfair advantage over the marketplace in because of your knowledge and expertise. Second, something that you can leverage, and you can leverage other people's time or other people's money. And third, something that you have control over, because if you don't have any control over the investment, then you're just at the mercy of the market or whoever's managing the investment for you. So those are the three components of good investments. And like, if that's the formula for wealth, where does tax even fit into it? And the answer is, it's not the main thing. And that's kind of the underlying point of this whole presentation. Is it's important, and wealthy people absolutely think about taxes, and it is something that, everyone should be thinking about and planning for, because it's one of the most significant expenses that we have. But what it really comes down to is tax affects income, because saving taxes will give you more income with which to invest. And taxes can be part of this leverage equation, where some investments that you make, you can essentially leverage tax incentives that are in place. That's honestly, that's what the tax code is I guess a set of incentives that the government has put in place to try and get us to do certain things to stir the economy in specific ways. And that, like, those two areas, that's how taxes affect this wealth equation. It's not everything. And that's the point that I want to underline, because there are a lot of people pushing messages that say, you know, essentially like tax savings are what generates wealth, and that is simply not the case. And so we don't want to go nuts when it comes to taxes, but there's still a lot that we can do. So I wanted to talk through a specific client, and his name is Nathan, and he, in 2022, so his income is usually pretty high, but it was especially high in 2022. So this was kind of a balloon year for him. And so he had a $12 million payout coming from several investments that he had. And it was really interesting to watch his approach to this, because he basically wanted to know what options were out there. And we brought the option to him to say, okay, you know, you might want to think about this charitable LLC. A charitable LLC, this is a legitimate strategy. There's nothing illegal about it. But I'll get to it actually here in a minute. I'll talk about it in more detail. It would have given him about $2.7 million in tax savings. And in theory, wouldn't have cost him anything in terms of actual access to capital. So it sounds great on the surface, but he decided not to do it. He just passed on the opportunity, and he passed for a couple of reasons. One, he couldn't fully understand it. It was just, he wasn't going to put in the time to fully understand it. It couldn't be explained to him in a way that was simple and made complete sense. And he just, you know, it wasn't something he could grasp and be completely comfortable with. Second was the fees were too high. There are some pretty intense attorney's fees and management fees for attorneys to actually go and set this kind of thing up and maintain it. And he sort of, his spider senses went up, and he decided not to do it. And the other one was just concern over risk. Again, kind of going back to the piece that he didn't fully understand it. It is a legitimate strategy, but he wasn't, you know, he's worried about getting audited and doesn't want to deal with that hassle in his life. So, like, here's what he actually did. This was his baseline tax return. He was going to owe about $3.8 million in tax. He did contribute $2 million to a charity, but that charity was a donor advised fund. This is like a time-tested charitable strategy where, like, he was actually getting rid of $2 million. But it's within a donor advised fund, so he controls where it goes. He's not just handing it over to an organization. He will be able to manage it and break it into various organizations, but it's committed. And he set up an extra entity so that he was able to pay his state tax and deduct it federally. So he paid his state tax through this entity, through the pass-through entity tax, and deducted it federally. So his charitable donation saved him $767,000, and then using this pass-through entity saved him another $157,000. So total, he reduced his tax bill by $925,000. But he still paid $2.8 million in taxes. The other areas where he saved money is, you know, he had structured this in a way where a large portion of his income was long-term capital gains. So he's only paying 21% tax rate on those long-term capital gains. So this is like a perfect example of how I have seen over and over wealthy people approach taxes. It's not that they want to pay zero. It is that they want to manage the tax rates. They want to do what they can do within reason and without putting themselves in a risky position. And then they're happy to move on and pay the tax because they know that there are going to be other opportunities out there, and it's not worth sacrificing something in the long term um, for a short-term gain. And I think that the common perception is actually the opposite. It's that they're doing these complicated strategies and getting, having some offshore account and some, kind of some super convoluted strategy. And that just isn't the case. So let's go through here and just talk a little bit about what principles I have seen them follow. One is they think long-term. So they never want to lose money. So that idea of like putting money into something that you don't fully understand would fall in that category of they want to be really, really sure that they're not going to actually lose money in some scheme that they don't understand. The other one is this: be fearful when others are greedy and greedy when others are fearful. Both of these are Warren Buffett principles, and they they apply here in that, like, he was looking at these lawyers' fees and sort of just sensed that people were being greedy, and that was a red flag for him, and he was just kind of out. The other one is quality of life comes before money. So we're going to talk about this when it comes to some of the strategies that they don't choose and why that is. And then the other one is like no surprises. They do not want to have any kind of surprise, and that goes back to the understanding piece. So what are the strategies that they don't use? The first one is a really common one that's out there, which is this idea of moving to Puerto Rico. We have had clients who have moved to Puerto Rico before. They're not the wealthiest clients, and they almost always end up coming back a few years later. And then they have to, you have to pay a bunch of money to get this set up. So the reason why you would move to Puerto Rico is because it's a US territory, but it has a different tax code. And so you can pay the Puerto Rico tax of like 4% and not be subject to US income tax rates. But there's a whole lot that has to be done there to move businesses over and to set up, close the actual entities down in the United States and then reopen them in Puerto Rico. And usually it, is going to cost somewhere between $50,000 and $100,000 in fees to get that done. And then almost always what happens is people, after usually a pretty short amount of time, a year or two, realize this is like affecting my life. This is costing me time with my family where I want to spend it, it's hurting my business. I'm not making as much money as I otherwise could, because they're spending all this time dancing around this idea of spending over half the year in Puerto Rico. And the wealthiest clients that we have, they're not using these kinds of strategies. They are looking more in the long term, or saying, I know that I can, make money. I'm not I'm okay paying a little tax, because the quality of life piece is a major factor for them. The other one is complicated insurance policies. So these really come into three different, it's really two different buckets, but captive insurance is a really common one. This is essentially where you can have your own insurance policy. You pay the policy you open a company that is an insurance company. You pay your insurance premiums to that company, and then you can deduct those payments, but the money's going from one pocket, from one company that you control to another company you control. And so you keep the asset, but you're able to take the deduction. It sounds great. It's also very expensive and kind of gimmicky and really difficult then to unwind if and when it doesn't make sense. And they get audited very frequently. And this is another one. I mean, all these fall in the same category. These are strategies that are used usually by people who earn high income but are not wealthy, and are focused a little bit in the wrong direction and trying to save taxes in order to get wealthy. And that just generally isn't the best way to do it. And the other one is cash value policies. And these ones are really heavily advertised. It's also known as infinite banking. So if you've ever seen that, it's the idea of you invest into a cash value life insurance policy, and then you loan the money back to yourself. But with all these, there are a lot of people are making pretty hefty commissions off of all these strategies, which is why they're advertised so heavily. And they're just not generally beneficial in the long term. They have this sexy looking tax savings number associated with them. But when it comes down to like, how tied up is your money? How many people are taking little commissions off that money and siphoning off portions of the money? They end up not holding water if you really do the analysis on them. And the other one is these charitable holding companies, which, again, are marketed pretty aggressively because there are some pretty hefty fees that go into them. But they ultimately end up being kind of gimmicky. Like, the idea is that you would put money into an LLC and then donate the shares of that LLC to a charity, while the cash actually stays in the LLC. And because the cash actually stays in the LLC, then the LLC can invest it into an investment company, which you, the shareholder, own and control. And then that investment company can put that into investments that are ultimately tying back to you. And it's covered by a life insurance policy so that if you die, all the cash goes back. And ultimately it does create a charitable contribution, which is why they are legal. But they're also, again, very expensive. So if you're going to put a significant sum of money into this, but have to pay a few $100,000 in fees in order to make it happen, it, one, diminishes the value of it, and two, just exposes you to all this complication and risk and extra hassle that takes away from wherever you want your main focus to be. So again, it's not that these strategies are illegal. They are all legal when done correctly, but more often than not, they're not practical and they don't make sense for most taxpayers. So then if not these, like my job is to help clients help entrepreneurs save money on taxes, not tell them to not bother. So okay, what should we do then? The first thing is plan ahead. And this really comes back to that idea of no surprises. That's one thing that I have observed over and over again, is if we plan ahead, one, we don't run into these cash flow issues where there's a giant tax bill that kind of comes out of nowhere. And two, it allows us time to actually make changes proactively with a clear head and decide what to do. Where does it make sense to just set some cash aside and pay the tax? And where does it make sense to get more aggressive and try and do something to mitigate the tax? And then if we're going to move on and mitigate tax, the biggest areas are, and I'm not talking about deductions here, because like most really wealthy people they're maximizing deductions. They want to deduct everything they can. It's just, it doesn't add up to a significant amount of money relative to their overall tax bill. So, and they understand well enough that, like, it's not about spending money on things you can expense. It's about investing. So they want to invest into things that have tax benefits. And usually that means a tax deferral or a tax write-off completely. And generally those fall into three categories. One, investing into businesses, which is where we get to entrepreneurs investing back into your own business, and making that into an asset separate from the income stream. Critical. That is the place to start, to go from like 0 to $1 million, or like to get to that first few million. That's almost always done through the value of your business. And that doesn't have to mean that you sell the business. It could mean that the business is turned into something that's cash flowing passively. And the value of those cash flows over time is that of a multi seven-figure dollar asset. But the business is number one. And then number two in terms of like how common it is actually real estate. Real estate is, you have the business and then you buy the building that the business is going to operate out of. And then you start accumulating some rental properties, and you have these different assets, all of which have tax benefits to them that help offset the total amount of tax that you would otherwise pay, and allow you to then have more money to plow back into buying more assets. Really, truly, most wealthy people are not sitting on loads and loads of cash. They have enough cash and access to cash to be comfortable, but their wealth comes from the assets that they own and the appreciation of those assets, which is not taxable until and unless that asset is actually sold. And a lot of them, are not selling assets. So they're sitting on all this wealth and it's not taxable because they don't have the transactions to actually trigger the tax. And then the other one is farming. And farming, comes in sort of in the middle of business and real estate. But the reason I say farming is because there are some good tax benefits for it. And for a lot of wealthy people, this just is a place to put money into something that sort of gives them some kind of quality of life, where it's kind of a hobby farm, or they're doing something like that, where now this thing that kind of gives them joy is also something that they can run as kind of a business that isn't intended to bring a bunch of profit, but allows them to write off all these things that would otherwise be paid for after tax. Those are really, honestly, the main three categories. There are a lot of subcategories within that, but probably the biggest area where tax benefits come is from investing into one of these three categories. The other one is entity structures. And if you've gone through the course, or if you have heard me talk about this, you've probably seen this in some form or another, but like that, this isn't crazy complicated entity structure stuff. It comes down to making sure that you're paying the lowest tax rate possible. And generally speaking, that's going to mean that you have one single S corporation and you have one, usually like spousal partnership. And you run all of your ordinary income, all of your business income through one, and take all the deductions you can right here. And then only one single business is passing up income to your personal return. And the same thing basically is true for the passive side. So this could be investments into REITs or other passive type businesses, or it could be multiple real estate properties that you own directly, or both. And all of that funnels into one single LLC, and basically you have everything passive on one side, everything ordinary on the other side. And then there are a few exceptions to this, but the only real thing that happens beyond that is income can get so high that at the personal level, you're taxed at 37%, plus you phase out of many deductions like the qualified business income deduction. And you start getting these extra taxes tagged on. So you get like a net investment income tax. That's another 3.8%. And so now all of a sudden you're above 40% federal tax rate, plus whatever state you're in. So the kind of release valve that a lot of wealthy people use for this is using a C Corp. And the reason for that is they can basically take their income, they shift a portion of it over into a new business, and that business is taxed as a C Corp. And that C Corp is only going to pay a flat 21% tax. So you're saving 16 cents on every dollar. And again, this is generally done for a few $1 million at a time. So you're saving hundreds of thousands of dollars in tax, and you end up with more cash over here in this C Corp, which is not directly. So that cash is not, it's owned by the C Corp, not by the taxpayer. But the taxpayer still controls what happens within that C Corp. And so then they can make other investments into, businesses or real estate within that C Corp. Again, all of which ultimately falls under their umbrella, but it doesn't show up on their individual tax return. So that's typically what's done from the entity side. And then the other one is charitable giving, which, a lot of wealthy people actually do quite a bit of. But the way that they do it is in like taxed incentivized ways. So one, they will donate appreciated assets. So typically this is stock. So instead of selling a stock and then taking the capital gain on that stock and then donating the cash, they'll donate the stock directly. And then they don't have to claim the capital gain, but they get a deduction for the market value of the stock. So this is a little bit of a loophole that wealthy people use all the time to essentially like supercharge their charitable giving and the tax deductions that they get for it. And the other one is they'll put usually a lot of these deductions into donor advised funds. so that they still have some control over it, and they can make sure that the funds, like, there's nothing nefarious about it. The funds are not like cycled back to them or anything like that. But it's so it's still real charitable giving, but it gives them the ability to still kind of determine where it goes and what actually happens with the money. Jenny, let's see, I just saw your comment. Can you buy a rental property through your business even if it's not used in your business, or would you buy from a separate LLC and would you form a separate LLC and buy the property through the alternative LLC? Yeah, typically speaking, Jenny, you would, let's see if we can go back here. Typically speaking, the real estate would be through this other, through this passive income side, and you would open a separate LLC that would own the real estate, even if that real estate were to be used for your business. Now, that's not always true. So let's say you own a business and this is going to just be a rental property, then 100% it's going to go this way. The only reason why you might not do it that way is if it is actually a business that's going to, if it's actually a building you're going to use for the operation of your business. And the reason for that, just kind of high level, is because you want to be able to take the deduction for that building against your income from the business and not get hit with passive loss limitations. So in some cases, you might, if it's a building you're actually using in the business, you might open a sub LLC, buy the building here, and then let that funnel up through that LLC. But either way, it's going to be another LLC. And the reason for those LLCs are you want to avoid mixing any liability associated with a building with the liability of your business. So you don't want something that happens in your business to jeopardize the building or vice versa. So not a tax reason directly, but a liability reason. Okay, so last one, I just wanted to give kind of one more example here. This is this client's name is actually Brian, same as me, and he has about 5 million in passive real estate that he's just kind of accumulated over time. And so he's got a good amount of income that he doesn't really have to do anything for. And he has some ordinary income on top of that coming in. And this is what his planning looks like. He shifted over some of his income to the S Corp because he was getting more in wages from his company. He had a couple of different businesses that were as S Corp. So he was paying himself more in wages than he actually wanted to. And so he shifted over to an S corporation. He took advantage of, basically kind of scooped up all the deductions he could with the accountable plan and Augusta rule. And then he did a cost segregation study on a new building that he purchased. And that's it. You know what I mean? Like a cost segregation study basically is just it's the vehicle that we use to take a building that we can only depreciate over 27.5 years and instead break it into its smaller components so that we can depreciate it faster. And that's it. None of this is like rocket science. None of it's offshoring stuff. None of it's anything like that. And because most of his wealth is sitting in actual assets and not in the form of income, and he's just done this over and over and over again. And so his income, in any given year, you can see like on a cash basis, it's pretty close to this 255. But by the time he's done with doing tax strategies, it's down to about $89,000, and his tax on that is pretty, it's pretty minimal. So $5,000 in federal tax, down from what would have been 34. And so this $29,000 tax savings that he gets from these relatively ordinary tax strategies is what he then uses to plow into the next property next year. And you just kind of continue doing this, and it continues to build a portfolio of assets that is what generates the long-term wealth. I wanted to communicate this because, again, like, I get questions all the time about these more advanced tax strategies. I'm not saying they don't have their place, but truly the power in the tax strategies, and I mean, you can see it here. Like this is We cut a $35,000 tax bill down to a $5,000 tax bill. It is significant, but it's not a magic wand. It's some basic strategies and then applied proactively and looking ahead and taking the time to say, okay, what's coming? What can I do about it? What's available to me? And I'm still going to be okay paying a little tax. Like, we don't want to get obsessed with getting down to zero. Generally speaking, the lower the tax gets, the lower the tax rates are. So we're less incentivized to do more and more each year. And we would kind of rather keep our powder dry and save some of those strategies for future years.